Patel with Palisade Radio. We're continuing our one-year anniversary relaunch, and following our interviews with Mark Faber and Frank Holmes, we're bringing back one of my favorite guests to the program, none other than Rick Rule. Rick, welcome back.
Thanks for the opportunity, Colin.
Last year, you predicted a long bowl-shaped bottoming process for the junior mining sector, with a strong possibility of bifurcation whereby the stronger companies could lead the new bull market, while many weak companies continued downward. As far as I'm concerned, that has been spot on. Looking at the HUI, we've formed a classic bottoming pattern that is starting to move upwards. What is the chance that the bottom is not behind us?
I think the chances that the bottom is not behind us are quite low. The only thing that I think that could cause me to be wrong would be a repeat of the global financial crisis of 2008 and a liquidity squeeze. In a liquidity squeeze, of course, the investor doesn't make the sell decisions, the margin clerks do. And anything that has a bid gets sold off. But absent a liquidity squeeze of the 2008 style, I think the bottom is solidly behind us. One of the nice things about making a lot of predictions, Colin, is that occasionally you get one right. And you did describe that one as spot on. In fact, what we've seen has been the bifurcation that we talked about. But we've also seen, importantly, higher highs and higher lows, with advances then filling in technically, which is precisely the stair-step chart that one would expect from a saucer-shaped decline, coming out of a bear market into a bull market where stocks are moving from weak hands to strong. It's playing out just precisely the way that it should be playing out.
Rick, obviously investors hold different tolerances for risk, but for the benefit of this question, let's throw risk out of the window. For the sake of argument, I'm a young guy and I want to make 20, 30, or 40 times my money over the coming bull market in the junior mining sector. Of course, I could hand my money over to Sprott, as the last go-around you produced gains of 2,200%, but that would be too simple of an answer. So what kind of disciplines and decisions would one need to make to achieve these goals?
I think well, first of all, the types of gains that you're talking about can only occur from speculation. And they can only occur from very volatile, very risky sectors like early stage technology or mineral exploration. What you need to understand importantly is that at this level, these aren't asset intensive businesses. They're people intensive businesses. They're really research and development businesses. So concentrate your speculative efforts on the very, very, very best people. Concentrate on the Lucas Lundins. Concentrate on the Ross Beatties. If you want to go with younger teams, they're around, the folks at Oxygen Capital. But take the very, very, very best people. There are $10 million market cap companies now that have reasonable ranges of assets, but very good people. And importantly, they can stay funded until the market turns. That $10 million market cap company with a good team behind it, when the market returns and it catches a bid, will be a 100 or 120 million market cap company. That's the way the game is played for a young, aggressive, well-funded speculator.
Let's look forward to year 2017. We're 3 years into a raging bull market in junior resource stocks. As an investor or a speculator, I want to maximize my potential gains, but not risk getting caught in a crash scenario. You mentioned in the past you've exited your positions too early, failing to realize the full potential of these bull markets. How do you know when it's time to get out? Do you utilize objective metrics or rely on intuition learned from past cycles?
I rely on intuition. And when I said I exited too early, in retrospect, what I guess I was saying is that with the bulk of my sales, I missed the absolute top. When I look at the dimension of the decline that we've just suffered through, I'm beginning to think that exiting early was just right. The important thing for a young speculator that manages to turn $50,000 into $1 million is to make sure that he or she keeps 700,000 of it. It's very important to do that. When the market is just rocking and rolling, and you think you're the smartest person on the face of the earth, and you think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid. Take 75% of your capital out of the way. put it in pipeline and port infrastructure stocks that have a good steady yield and sit out the decline. Don't try and maximize the last dime in a $2 position. Make sure that you don't hold it back to 20 cents.
And shifting gears a bit, what are your thoughts on the Newmont and Barrick merger and M&A as a whole right now?
The Newmont and Barrick merger, if it doesn't take place, it will be a black mark on the directors of both companies, and more importantly, a black mark on all of the institutional investors who hold both companies. Merging two companies, the consolidation of G&A probably saves the shareholders of the combined companies $1 billion a year. These companies are based on a multiple of EBITDA. Let's call it a 10. That's worth $10 billion in market cap, and it's important to note that that's a mine, if you will, $1 billion a year mine that doesn't have to deplete. This is a merger that has to take place. One of the great tragedies in the mining business for the last 30 years has been the incredible creep in general and administrative expenditure. And that needs to be dealt with through M&A. Higher quality teams need to manage more and more assets and more revenue per G&A dollar. And the way that you accomplish that is through merger and acquisition activity. It has to happen. The management teams attempting to win the last man standing contest, which is really a salary maximization contest, have stood in the way of M&A for 20 years. And the investors in the world simply cannot allow that to continue.
Last year when we spoke, we discussed Tower Hill Mines and Exeter Resources as prime examples of optionality plays. How do you explain to an investor that buying a stock with a market cap of $50 million that owns a project with a capex of $5 billion will be a fruitful speculation with rising gold prices?
Well, there's two answers to that. In the first instance, if the gold price were to go up substantially, the net present value relative to the upfront capital expenditure rises substantially. The problem in today's gold market is that the upfront capital expenditure does not get recouped at today's gold prices. If the gold price were to go up to $2,000, all of a sudden that upfront capital expenditure becomes much less onerous. The second thing is that capital becomes much less available. What happens when management teams of small companies take advantage of optionality is that they hold a project and perhaps advance some aspects of the project slowly. But they do it with the point of view that when the commodity price turns in their favor, that rather than develop that property, they're going to sell it to somebody with the skill sets that can develop it, for whom the hurdle of the upfront capital costs is not such a huge disadvantage. I would also tell your listeners that if they intend to play the optionality game, that they really need to watch the general and administrative spend in the companies that they own. The key to succeeding in the optionality business is a very difficult task. It's doing nothing. Leaving the gold in the ground and not spending a lot of money on it. Management teams don't like to do nothing, and particularly they don't like to get paid appropriately for doing nothing, which is not much. And what happens over the 3 or 4 years that you need to hold an optionality play for it to mature is that often your holding in the optionality play is diluted by equity issuances to fund general and administrative expense or useless project expenditures. So it's very important that these assets that are optionality assets be put in the deep freeze, and the expenditures at a corporate level are reduced to an absolute minimum, which of course the managements hate.
You've mentioned in previous interviews that two of your favorite commodities right now are water and uranium. Can you talk about these seemingly different commodities?
Well, water, certainly. Water is a localized market on a global basis, and I think I tried to say that it's important if you're going to speculate in water, that you speculate in a place where water is scarce to begin with. I have a difficult time telling my Canadian colleagues at Sprott that water is a good investment when they look out their window and see Lake Ontario and their challenge is to make the water go away. So you have to invest in water in places where water is scarce, and also you have to invest in water in places where people can pay for it. Having water in Bolivia or Somalia is no good because although they need it desperately, they can't pay for it. So it has to be in places like Southern Australia or the U.S. West and Southwest. A bad pun, the water market is illiquid. There are very few vehicles that one can use to play water. And the water rights business, which has been so good to me over the decades, has suddenly gone no ask. The water rights are being bought up. So although I like water now as an intellectual exercise, the stocks are all up by 50 and 60%, probably going higher, and there are not many water rights to buy. We are studying internally at Sprott the creation of a water investment vehicle, and if we're able to do that, I'd be delighted to talk about it more at that point in time. But right now, it's sort of a gleam in our eye. Uranium is a very different situation. There are a multiplicity of vehicles for uranium. What that requires from the investor is patience, because it could easily be 2.5 years before a uranium bull market gets underway in earnest. A lot of market participants are excited about the fact that uranium is up by 10 or 12% in the last 6 weeks, but that's merely recovery from an oversold position. It's a technical rebound, and a rebound that has something to do with the fact that Cigar Lake has been postponed again. Looking further forward, however, Cameco, who I think should know, suggests that the industry average cost for producing a pound of uranium, including cost of capital, is about $70 a pound. And the value proposition offered up by the industry is they make this stuff for $70 a pound and they sell it for $32 a pound and try and make it up on volume. The logical conclusion of that is that either the price of uranium goes up or uranium becomes unavailable, which means the lights go off. You know which way I'm betting.
Rick, compared to your past bull markets you've participated in the junior sector, do you anticipate this being a bull market to remember, or is there a bull market you can compare this to that you've participated in the past?
You know, they've never been the same. The bear market that wreaked the most havoc was the one in the mid-'80s because it followed that epic bull market of the '70s. The recovery from that bear market really in the juniors took all the way to 1992. The 1993 to 1996 bull market was the most vicious bull market I've ever seen. It was literally a melt up where 10-cent stocks in 2 months became 35 or 40-cent stocks across the board. The collapse from that was, of course, vicious but short-lived. What is different, I think, about the bear market that has preceded this bull market was not really its duration, but its viciousness. The TSXV declined by about 75% in a little under 3 years, a truly torturous decline. And importantly, this bear market decline happened when the industry was extremely well funded. So what's unusual about this is that the remaining companies have built up some very interesting asset bases. I suspect that this bull market, when it gets underway in earnest, will be very, very, very generous. But I would caution your listeners to remember what we said last year. This market is bifurcating. There are 60 or 70% of the listed juniors on a global basis worldwide that are worth nothing, and they may still go to their intrinsic value. The best 30% of the issuers, or better yet, the best 10% of the issuers, will truly surprise people when they get going. And remember this, Colin. Bull markets occur when markets as a whole exceed expectations. Expectations for natural resources and expectations for junior natural resources in particular could not be lower. It is going to be very difficult for the next 18 months not to exceed expectations. The challenge with regards to expectations would be to get under the bar, not over the bar. This is the stuff of a bull market, not the stuff of a bear market. There's not much disappointment left.
Very good point. Final question. Can we get a target for the HUI index by the end of this bull market? General number.
No idea. Honestly, no earthly idea. I am attracted to the gold price. I am not as attracted to the HUI because there's too many junk companies in it. Just in the way that I'm not attracted to the XAU and I'm not attracted to the GDX. Market cap weighted indexes don't work from my point of view. That's one of the reasons why we started the Sprott Gold Miners ETF, where we have a qualitatively weighted index rather than a market cap weighted index. The industry as a whole is still too inefficient to buy the industry. You need the select stocks.
Fair enough on that point. Thanks so much, Rick.
Colin, a pleasure. Good luck in Guatemala.